if you know what you're looking for, that's the thing as well. If you know what you're looking for, that doesn't change. There's a price. Here's my stops. Market gets to that price. Do I care if it goes up? Do I care if it goes down? No, I don't, because I know that the market has to move.
What's up, everyone? How are you doing? Fine today. Coming to you this week with an interview with Paul Scott. Paul Scott is a supply and demand trader who's been in the market for multiple decades now, roughly 30 years. He started back trading on the London Metal Exchange in the 1990s, helped along by his father, who was a copper trader. And he's got this unique touch on supply and demand that I haven't seen many traders talk about. So hopefully you'll gather some good knowledge on this. Plenty of good stories here and good experience from Paul, and we'll dive right into it. So Paul Scott, welcome back on the podcast. Good to have you here today. We spoke a few years ago and look forward to catch up again and see what you're out doing trading these days.
Indeed. It's been a bloody long time, mate. But I had another baby since then. He arrived this year. So it's been all hands to the pump. But all good, mate. How are you?
Awesome. Very good. Very good. So how the time? We're going to publish this, going to be early in the year. So I kind of want to take a step back and you kind of go through how the year's been for you in trading and kind of what things you're looking for next year.
Well, if I'm brutally honest, having had the baby again this year, I've sort of taken pretty much a back seat, really, with regards to trading, because he's there, sort of helping out mum and, sort of picking up the pieces behind and stuff like that. So for me, trading's been pretty quiet, but I have sort of still been teaching people on a small basis. I haven't been doing, sort of too much. I haven't been working with too many people this year. But I mean, for me, every year is pretty much the same. I approach it with the same, sort of mindset. I realize how insignificant I am inside of the game. I realize that being directionally agnostic is the best thing for me to be. That's just what I sort of teach to people as well. That markets are split up into ranges. I want to be trading from the top and the bottom of those ranges. It's patient, it's disciplined, it's boring, but if sometimes the best things are boring. What do I foresee for next year? But I think it's going to be a pretty busy year. I think we are on the cusp of some sort of real big moves. We're looking at sort of had a quick look at the gold chart before we sort of came on. Can sort of see some year-end profit taking going on there, which doesn't again really surprise me, to be honest. I think next year is going to be pretty exciting, pretty good. Will we continue to see higher highs in the US stock markets? Most probably. Will there be a big drop and a big crash coming somewhere around the corner? I think most people around the world are probably thinking the same thing, that will probably happen at some stage. And again, if you're directionally agnostic, you can catch that move to the downside. It can be a very profitable year for you.
Walk me through how you came across supply and demand trading and how you've been able to use it since then.
That really sort of harks back to my dad, and I'll tell you a story about that. So supply and demand is basically cheap and expensive. It's about how everybody thinks about value, So again, you've been taught that from a very, very young age, how you think about value. But to sort of have sort of supply and demand in there is, so on the London Metal Exchange back in the day, you would trade in tons, and they could be any amount of tons. Then as that market sort of started to get a lot bigger, they wanted to sort of standardize it. So these days you would trade in lots. But one lot of copper would now be equivalent to 25 tons. But before that, you could trade, 5 tons, 7 tons, 13 tons. And there was this crossover period where they were still trading in tons, but then also trading in lots. And so Dad said, I'm down there on the floor. It's coming up towards the close. It's a Friday afternoon. And his clerk whispers into his ear, Harry, buy 1,000 lots at market, make as much noise as you possibly can, and go and make it close above this particular price. So he says to himself, well, he can't mean lots, because if he does, that's the biggest order this market's ever seen. So he must mean tons. So he goes, makes a bit of noise, goes and buys 1,000 tons, jumps out of the pit, grabs hold of the phone and says, right, who was that order for? And they said, oh, it was for Manfred upstairs. Now, Manfred was the owner of the company. And so he said, Manfred, he said, oh, you bought your 1,000 tons at. And Manfred screamed down the phone at him and said, Harry, I said lots, not tons. Get back in there and do as you're told. So my dad's like, shit, drops the phone, runs back in, copper, 95 I sell. Yeah, I'll take 500 off of you. And the guy's like, no, you can have 50. So 95 I'll give, 98 I'll give, 00 I'll give, 05 I'll give, blum, 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 blum. And so the bell goes at 5 o'clock, hasn't bought it all, but he's made it close above a particular price. And so he grabs hold of the phone. He says, Manfred, look, we've bought around about half of it. We'll give you an average price in a minute. We'll work it out for you. Why on earth did you do that? And who was that order for? He said, that order was for me. And he said, come back to the office and I'll show you why I did it. He said, okay. So he said, I was intrigued. So what you got to remember is this is the 1970s, so no computing power. This is, charts that were done on A1 sheets of graph paper, right? And so Manfred had prices that went, all the way back to the 1950s. But what he showed my dad was, look, price gets to this, market gets to this price. What happens? Comes down. Why? Because people say, okay, there's going to be supply there. Why? Because people deem it to be expensive. So then therefore they want to sell. Okay, so then a few years later, the price gets back there again. Same thing happens. A few years later, the price gets back there again. What happens now? Well, now the price breaks above there and it closes above there. So essentially what's happening here is on a global scale, the value of copper at this particular price, at this particular point in time, is no longer expensive as it was previously. Now it's cheap. Market goes up, he said, and then subsequently it's come back down and it's closed back below it. But what have we done today? Well, we've made it go and close above that price again. So I can kind of guarantee you that next week, because we've changed the perception of value on a global scale, the price of copper will go up and we'll sell out what we bought today and we'll make a ton of money. So and that's what happened. But so it's like supply and demand, it's the perception of value. So the same price can have different values over periods of time. So if you know that when you get to this particular price, there has to be a decision made by the people that are trading it. Do we value it as cheap? Do we value it as expensive? So is there going to be supply there or is there going to be demand there? And so if all markets are split up into particular ranges, then that's where I want to trade from, these key decision-making prices. And that is then transferable across to any market whatsoever because, again, what people have got to think about is the humanity on a chart. Can you read that humanity on a chart? Do you understand that there are people that are really doing this as a real job? And once you get to read the language on the chart and you think about it, and I say to people, hey, look, imagine you're down on a trading floor and you've got all these people, sell at 5, sell at 5, sell at 5, sell at 5. You can see that on a chart if you learn how to read it. That, for me, is one of the biggest advantages that you can ever have. Is if you stop looking for candlestick formations or you stop looking for engulfing candles, or you stop looking for whatever it is that people look for in the retail market. If you can learn to read really the humanity on that chart, that's a huge step forward for you. Huge step forward.
If you are enjoying this interview so far, then I think you'll like this one over here. I've been working on this book for a long time called Prop Trading Secrets. It's finally out. You can get it in your favorite bookstore or on Amazon, Barnes & Nobles, of course. And this book is really about interviewing traders who are successful in either trading for prop firms or managing their own private fund. We talk about their background, what makes them successful, the things they went through, struggles they had to go through to become good traders now, and a lot of the good wisdom that you might not necessarily hear about, but it's all into a condensed version over here. You can read through these stories, get inspired, of course, learn a lot about what they do, their strategy as well. And we summarize everything at the end where you have a whole chapter of summaries of what these traders have in common. So if you want to check it out, 14 traders in this book that myself and Kathy Lean interviewed. There's a lot of good wisdom in this. If you like these interviews on YouTube, I'm sure you like this one for sure. Go grab it. Like I said, it's on Amazon, Barnes & Noble, it's on Audible in audio version. All the other audiobook platforms will have it too, or your favorite bookstore. So check it out. If you did read it, let me know in the comment section below which one is your favorite chapter, and we'll get back to the interview. I feel like that worked well many years ago when the charts was like simple, people had like no computers, but now with all the technology, we have all the traders in the market. Do you feel like it's a bit harder to make money with supply and demand? Do you feel like it's like the charts are a bit less clean than they used to be?
No, because I think if you know what you're looking for, that's the thing as well. If you know what you're looking for, that doesn't change. Because again, what you got to think about is the people that are doing this as a real job create what you see. So if I was to say to you, right, Etienne, come down the trading floor with me, you're going to come down there with me for a week. You're going to stand there and observe me shouting, screaming, buying, selling, borrowing, lending, boom, 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 boom. Again, you'd appreciate if you're on a trading floor, you're looking around. There's nobody looking at charts. It's all based around price. And then I could say to you, right, it's Friday, it's 5 o'clock, bell's gone. Let's go back to the office now. Let's go and see what's transpired this week. What does that actually look like on a chart? So as much as technology has changed, yes, it has. Has trading changed? No, it hasn't. And it never will do. So, I mean, if I was to say to you, right, you've just walked out the desert, and it's going to be a strange example, but you just walked out the desert, right? You're gasping for a bottle of water, and I'm standing there. I've got a water stand, and I say, right, bottle of water's $20, and you say, I'll give you 10. Well, there's your first market, it's 10, 20. And I say, well, no, you can have it at 18, and you say, well, no, I'll give you 12. And I say, you can have it at 16, I'll give you 14, and we shake hands at 15. Right? There's a trade. So let's just imagine that a couple of weeks later, again, you walk out the desert and you go, oh, it's that guy again. There's $15 for a bottle of water. I say, no, it's $25 now. Hasn't rained for a couple of weeks. Now you got 15, 25. It's the same thing, but now it has a different value. So has that fundamentally changed? No. Will it fundamentally change? No, because are human beings going to fundamentally change the way they perceive value? No.
How do you cut out the noise in all of this? Because I feel like a lot of people try supply and demand. They kind of see that there's too much noise. They lose money in a few trades and then they quit. How do you make sure that this doesn't happen?
Well, again, it depends on what time frames you're looking at things. So if you're looking at things from a perception of time, again, I think you're kind of looking at it from the wrong thing, the wrong place, because you've got to look at it as price. So price and value is how trading is always done. I mean, again, it's if you're looking at very short-term time frames, that's going to be random. That's going to be confusing. Why? Well, because now you're just walking straight into commercial business. So commercial business I would describe as this is the business that you're doing for your clients. So your clients will ask you to buy, sell, borrow, lend during the day. And if you go down too far, you're just going to walk straight into that. Now, if that is a truly random event and a random act, how on earth are you then supposed to, again, know or have a feeling for where the market's going? Again, I'll come back to it, but to be directionally agnostic and say, right, there's a price. Here's my stops. Market gets to that price. Do I care if it goes up? Do I care if it goes down? No, I don't, because I know that the market has to move. So get stopped out on the trade, manage the other one. But yeah, if you're looking at real sort of short-term timeframes and stuff like that, you're just going to get bulldozed because, again, if you don't realize that there are two sides to the coin, one is commercial, which is everyday business, and then the other one is going to be institutional, real institutional buying and selling, where you're using your trading account that you've been given by your institution to trade from. That's where you're going to step up to the plate. So it's about, again, price, value, learning how to read the humanity on a chart, learning how to read where these major levels of key decision making, where they are. If you can do that, again, you're miles ahead.
So you're okay with taking two trades in both directions and kind of cutting one at some point and keeping the other one for the big move, right?
Yeah, 100%. Because again, if you just said to yourself, right, look, I'm going to be humble enough to pay the market money for the information that I need to know. What information do I need to know? What's the current value? Is it cheaper? Is it expensive? Does the market go up? Does the market go down? If I pay the market money for it to show me where it wants to go, then if you can be humble enough to do that, then again, you're miles ahead because you're basically saying, look, I don't care where the market goes. I don't make money because of, I guess, the direction correctly. I make money because the market moves and it's going to move up and down. Do you sometimes get double stops? Yeah, of course you do. But again, that's just part and parcel of the game that you're playing. Because you pays your money, you takes your chance.
In what scenarios would you look at taking two trades in opposite directions like this? Would you look at like a breakout and then you take two trades, or is it only like for news events, or what tells you to go in both directions?
Basically, again, I've marked out on my chart ahead of the time. This is where I want to trade from. This is where this market's particular ranges are. This is its distance. So I always know ahead of time where I want to be trading from. Do I really keep that much of an eye on news? No, not really. Because if news makes the market move, then fantastic. I don't want to be sort of too cautious. Maybe some big major events I might sort of take a step back on, or maybe sort of certain times of the year, like, we're in December now. I wouldn't really want to be trading in December. Why? Well, because nobody's going to really want to take a position in December. Because, if you've worked from January up to the back end of November, you don't want to go blowing what you've made in December. So, yeah, it doesn't bother me that I'll definitely lose on one side, because if I then say, right, as soon as I go past where I got stopped out, I'm in the money. It's then about managing that trade.
How do you manage that trade? Walk me through your thought process for that.
Okay, so if I was to say, right, so I have a range and I say to myself, right, so I've got stopped out on one of them. Let's say I got stopped out on the sell side, right? So then the market's going, let's say I had a 30-point stop, let's say on the S&P as an example, I had a 30-point stop. So if I know the distance between my range, I say, right, let me get to the half point of that range. It's not a race to break even. So I don't want to move my stop too early, right? But I let it get to sort of 50%, and then I'm like, right, okay, well, let's grab that stop that's minus 30 points. Let's put that now to entry point. As that market continues to go higher, then I'll say, right, let me grab that. Let me move that to the 50% mark. So now I know, right, I've covered my stop, and now I'm in the money a bit. And then if that market continues to track higher, then again, there's nothing stopping me taking that stop and just incrementally following it up behind, knowing at some point I will either hit the top of that range and I get 100%, or the market stops and reverses and it comes back, but it stops me out in a positive.
A lot of people struggle with that because they tend to either do it too fast or like way too slow, or like they move the stop loss but it's like way too far behind and the price reverses and they get a big loss, or they do it like too fast and they want to move it fast to be able to catch more profits, but then it kind of goes against them. How do you find that kind of balance between both?
Well, I've always been one to say you got to be patient. You got to wait. You got to let that market move. You got to let that market breathe. And like I say, it's not a race to break even, because the minute you have a race to break even, again, you've got to expect that the market may very well come back to test that level again, just to see, in that example, is there still more buying than selling? If there is, okay, we just keep going up then. So, yeah, not a race to break even. But again, it's about being patient. It's about letting that market move. It's about understanding how a market moves, and a chart will tell you that, is this a sort of a market that moves quite rapidly? Is this one that moves a little bit slower? Again, if you learn to recognize how a particular market moves, then you can, do things accordingly. So if you were to look at a highly illiquid market, you would understand that would be up and down very, very quickly. Or if you looked at a more liquid market, it could take a little bit longer.
I think the difference between you and another trader who might not win at this is that you're gonna sometimes not trade some ranges or not trade some moves, and people that will go on the market trade everything, all the markets, all the moves. So tell me about scenarios where you wouldn't want to be trading in certain ranges or zones.
Well, I mean, like I said, so if I'm looking at the month of December, then that would be a month that I wouldn't really want to trade, because I understand that there's going to be book squaring, there's going to be profit taking, all that kind of stuff. Like I say, you're not going to want to risk what you've made between January and November. Would there be sort of a scenario where I would say I'm not going to trade a particular range if it gets there? Maybe a US election, obviously, because I know that can have a very big impact upon markets. Maybe going into a holiday period. Maybe again, you don't want to be, sort of trading. But I mean, again, I'm not scared. Really, I don't let the sort of the outside world sort of really influence what I'm doing, because I'm like, right, I'm at that price. I've been afforded an opportunity to take a trade from here because the market's got to where I want it to be. So, yeah, I'm not too scared to, put the money on the line and say, right, let's take this trade. If it works, it works. If it doesn't, it doesn't. That's, again, that's another scenario of, right, well, if it gets back there again, I'll have another go. If it gets back there again, I'll say, right, okay, well, maybe the market at this particular time can't make its mind up about the current value. So let's just leave it alone for a little while. Let's let it at least move, maybe sort of say halfway between the range, because then I can see that it's moved away from this particular price. And then if it gets back there again, then I'll take it again. But again, it's just saying to yourself, you are insignificant inside of the game. You can't influence how it works or where the market's going to go. So if you're afforded an opportunity, in my eyes, take it.
Would the height of a range matter? Like if you have a very tight range with almost no room for the price to go, would you still go in that trade?
A very tight range. Well, I would suggest that the ranges that I would sort of set out would take days, if not a couple of weeks, to complete in its cycle to go from the bottom of the range to the top of the range. So, yeah, I mean, on occasions you will have sort of days where, it's quite crazy and, you can just sort of do a whole range in a day. But yeah, the ranges aren't that small. So it's like I say, it's more patient and disciplined trading, but it's taking a step back and just realizing, less is more. It's not about how many trades I take. It's about the quality of the trades that I'm taking.
What defines for you a strong level for a trade?
I can see that there's key decisions that have been made. So to give you an example of that. So if you had an all-time high, and let's just say the market's dropped from its all-time high, that the decision there by the major players have said, right, that particular price here is overvalued. It's expensive. We want to sell here. If you then get back there again, from that particular price, right, now a decision's got to be made again. Is it still expensive? If so, the market goes down. Or does the market say, no, at this particular point in time, it's actually undervalued. So here you're going to now get demand. And then the market, let's say, breaks and goes higher. So those are major levels of thought processes by people that are doing this for a real job, as a real job. Now, if you can work out where these particular prices are and you mark up your chart within ranges of those, what you'll see is that the market reacts to these levels beautifully. And I've done this with many, many people over many, many years now. I remember a guy last year that I taught who I said, right, this is where this market's ranges are. Let's get rid of candlesticks now. We don't need to see them because we know the distance between the ranges. So let's go up the chart and then let's go down the chart just using these range numbers. And then what we'll do is then we'll pull the chart back across again. And then you can see with these particular candlesticks how the market's been reacting to these prices. So this guy had been trading, 6-7 years. And we do that. I ask him to pull the chart back across on his screen. He pulls the chart back across. I says, what do you think? And it seemed like forever. It obviously wasn't, but it seemed like forever. There's like about a minute's worth of silence. And I was like, are you all right, mate? He said, I'm welling up. He said, I can't believe how stupidly simple that is. But look how that market is reacting to these prices. He said, I can't believe it. He said, 7 years I've been sitting here doing this and I've never seen it. I said, well, you wouldn't see it because you don't know what you're looking for. It is ridiculously and stupidly simple, but super, super effective.
One of the common complaints I hear is people say that it's very easy to do on the historical data, but in real time, it's tougher for them to spot the levels. Do you see the same thing with your students? Is it hard for them to spot the levels in real time when in the market?
You spot the levels in real time when you say real time, the way I teach people is you do everything ahead of the time. So if you've marked up your chart, you then know, right, well, if let's just say gets to its all-time high again and it breaks above, you already know, right, well, this is the distance between these levels. Yeah. Let's just say on gold, as an example, it's $100. Right. So it gets to this level and it breaks and closes above its previous all-time high. Well, then you just add another $100 on top of that particular price, and you say, right, here's its new range. So here's the bottom, here's the top. So it's not necessarily about spotting them in real time. It's about knowing where they are and how you just add at the top, or if the market's coming down, you just minus from the bottom.
What are some of the common mistakes you see students make with supply and demand? Do they have all the same issues, or is it like a few things that they do wrong and that you have to tell them to fix?
Well, I generally say to people, look, let's go and have a look at the charts, but with a fresh pair of eyes. It's like, bullish and bearish and ticks and pips and all that kind of jazz. You know that. But let's go back and look at this from a different perspective. Let's go back and look at it and say, there are people that do this as a real job. What do they think? How do they look at markets? If they're not looking at charts, how do they make their decisions? And it's all based around price and value. So does everybody make the same mistakes? No. Has anybody ever turned around to me and said, aha, oh yeah, I've seen all this before? Never. And I've worked with hundreds of people over the years. Not one person has ever turned around and said, oh yeah, I've seen this. Everybody is like, holy shit, that's crazy. And that works on any market. Yeah. Right. Okay. So that means I could go and put a portfolio together. There's maybe, I don't know, 5, 10, 15, 20 things and just trade those for the rest of my life and do essentially really what is the most boring job on the planet. It's not meant to be exciting. It's meant to be boring, but done well, it pays well. So does everybody make the same mistakes? No. Has everybody been on the same journey? No. Has everybody looked at all different sort of types of trading? Some have, some haven't. Some have got lots of experience, some haven't. But the ones that have been doing it the longest realize just how much bullshit is out there being taught by people that have never done it as a real job. And so, they've been led down the garden path. And it's some of the stories that I hear are quite shocking. The amount of money that people have spent and time, and it's just gotten absolutely nowhere because it's all based around gobbledygook.
How hard is it to get someone to remove the old thinking or the old ways to see the market that they have? Like they might see patterns that don't work or that they don't need anymore, and then they come to your approach and they kind of follow it because they have these other old views of the market. How hard is it to get them to remove that?
That's down to the individual. It's down to how much sort of time they've spent looking at the wrong things. I mean, I did have a lovely guy over here who is quite high up in our National Health Service. And he said to me, I spent about £40,000 on various courses and books and DVDs and all this kind of jazz. He said, and none of it's worked. None of it's worked at all. He said, have you got any advice for me? I said, yeah, to take it out into the garden, put it on the barbecue and burn it all. And he did it. And he said, that's the best night's sleep I've had in years. He said, because I'm ready to sort of stop and start again. It's a very simplistic approach. It's getting people to stop looking at how they used to look at markets, I think, is not too difficult, because once they see the reality of what it is, it's just like, well, shit, if I looked at the chart in any other way moving forward, it wouldn't make any sense.
Yeah, that's what happens when you have your own approach and it works for you. Yeah, definitely. So tell me how people can connect with you and find you after this podcast.
Well, I've got the worst website on the planet. It's paulscottfx.com. It's super basic. I'm not one to sort of sit there and have all pop-ups and all this crazy crap coming up. I don't do social media. I always say I don't do social media, but then somebody pointed out to me recently, you can't help people these days if they can't find you, because everybody does social media. So, if you sort of look me up on Google or something like that, it's like I don't exist. So maybe I might have to jump on the bandwagon of, getting on social media this year, but not to do probably what is traditional social media, but just so that people can find me. But yeah, I mean, website, absolute rubbish, www.paulscottfx.com. Yeah, there's another interview on there that I did with another gentleman, but hopefully we can sort of put your one up there as well, and sort of go from there, buddy.
Awesome. Paul, appreciate the advice you gave here. We'll leave the link below for people to check it out and find you directly. And appreciate the advice you give to the listeners here. It's been a lot of fun. Hopefully we can catch up soon and discuss trading again.
Yeah, sounds like a plan.